welcome everyone to this month's webinar, and hopefully we'll going to spend a little bit of time just talking about some of the other things that you can talk about when you're doing your annual reviews with your clients. So I don't pretend to be a tax expert or any of that sort of stuff. So all of those things that you normally talk about, you'll need to talk. That's something that you know more about than I do. But there's an opportunity to talk about a few other things that I think may be worth looking at. So I'll highlight a few of those through the course of today and why I think they're important. Just as a bit of a general update on what's going on in the marketplace, April, from an insolvency point of view, the numbers remained high but seem to have plateaued across March and April. I think that's partly because of the fact that we obviously had an election and we had a lot of public holidays in last month, which were I don't know for you guys, but I found them rather horrendous. They certainly caused us a lot of grief in trying to run a normal business with all that leave. But having said that, as I said, the numbers are consistently high. We're not seeing a continual growth, which in some sectors that would be considered good. I do think, however, from what we're seeing coming through from clients at the moment, that there is a lot of the pre-work in terms of new CSDs, new director penalty notices, new garnishee orders coming through, that the activity is heightened. It just hasn't hit the court listings at this stage. So I would anticipate that we'll see that May will have increased numbers again. Not sure when we hit the limit of what the courts can handle on a day-by-day basis, but that's just something that we'll have to keep an eye on and watch. So I think overall numbers are still high and we're still seeing a lot of it. And we're now starting to see more of active businesses that are needing to go in, more than just some of the old deadwood companies that existed as we came out of the whole COVID period where things shut down and people hadn't done anything at all. So I think it's something to watch now, that more businesses that are active, still trying to stay alive, they're the ones that are now starting to get hit a lot more. So in some cases, the DPNs are for quite low numbers and for quite short periods of time. So the ATO certainly is getting active in trying to hit the buttons earlier. That can be dangerous because you go, oh, it's a small amount, I'll cover it. But if they're doing them regularly, then what you'll end up with is quite a large amount of debt that will accumulate on the director personally. In terms of major rates, in the last month, 40% of all insolvencies were tied up in either construction or hospitality. I think construction, I mentioned either last month or in our actual lunch and breakfast seminars, that construction had dropped to now being about number 6 in the most attacked area. And certainly hospitality is proving to be a very risky industry to be in at the moment. Makes a lot of sense, really, when you think about it. People's the cost of living is going up, so therefore discretionary spending is less available, and that's putting a lot of pressure on businesses. And we mentioned in the seminar that it was more the cost of doing business that was actually causing a lot of grief. And I noticed today that Creditor Watch are now saying the same thing, that it's the cost of doing business which is really putting pressure on businesses at the moment. So something to keep in mind as you're talking to businesses that might be in some of those areas. The other thing that I wanted to just do a little bit of an update on is around small business restructures. They continue to still being popular. However, we're now seeing an increased number of them actually being rejected. The ATO is really focusing on only providing those to what they would consider good businesses, whatever they may be. They're calling on or using the public interest argument for some of these businesses that would otherwise 3 months ago would have got through on a restructure plan are now being rejected. And although they're not using the formal words, it's certainly in some of their documentation that if it's not in the public interest, we just don't quite understand what their public interest component is yet. But we are seeing an increased number of SBRs failing. So when you are looking at it with a client, please make sure that it is the right structure, because if it's not done properly and doesn't meet all of the pre-checks or the post-checks that need to be done to make sure that it does stack up, what you could end up with is that you've wasted the use of an SBR because you're only allowed to use it once every 7 years. So you do need to be careful to make sure that you're actually using it the right way and you're set up the right way for that to work. So just a little bit of stuff in terms of what's going on in the marketplace. Believe it or not, Melbourne's actually having a moment of sun. So I'm actually caught with a little bit of sun coming in through the window. So I apologise if that's a little bit awkward. It's certainly, the sun's got no heat in it for those of for any of you who are down here. There's certainly no heat in it today. As I've said before, I will remind everyone that if you've got any questions as I go through anything, I'm happy for this to be as interactive as it possibly can when it's one person speaking to a multitude. So if you do have any questions, please type away in the chat box. I've got that up so I can keep an eye on it. Or you can unmute yourself and just ask a question. So happy for these things to be interactive. So, as I mentioned, I was going to talk about a couple of things to have a look at from when you're meeting with some of your clients from an annual review point of view. The next month and 7 days or 8 days that we've got left in May, I know can be a very busy period of time for accountants and bookkeepers and even some solicitors, as you work through some of the end of year requirements, end of financial year requirements that might be needed to be dealt with clients. When you're having those conversations, obviously you've got all of the tax stuff that I don't even pretend to understand all of it. That's not my area. But there are a couple of other things that are worth looking at, particularly in this environment that we are from a business point of view, where we do have much higher cost of doing business. And that's putting a lot of pressure on small businesses as they move into the next 12 months. The first one I wanted to talk about, and for me, this is actually a really big warning for everyone to be really careful of. As you would all know, from the accounting industry point of view anyway, from the 1 July, the ATO has made their interest for integrated client accounts and any of their interest charges become non-deductible. Now, the warning for me, for you in all of this, is that it has become a really big marketing point for financiers. So I've seen numerous advertising structures being put in place now where they're actually marketing to refinance tax debt out of payment plans into finance debt, so that you can continue to maintain the tax deductibility of the interest. The reason why I consider this a really big, something that you really need to be worried about is that, and again, some of you have heard me talk before, will know what I'm talking about here, is that we're turning an unsecured debt into a secured debt. And it's something that I think you need to be really mindful of. I've already had a number of phone calls from accountants saying that we've got this issue, we're looking at refinancing. Is there anything we need to be aware of? Now, the first thing I'd be saying is, yeah, the one thing you need to be aware of is that you're actually going to put the debt on a house. Most of the time, they're not unsecured, most of these loans where we're refinancing tax debt. And is the viability of your business so strong that you have absolutely no doubt that it can be paid back? Because what we're finding is that people who have financed debt in the last 12 months to pay out tax debt are now coming back to us going, business hasn't improved. It's very clear that the next 12 months, and maybe even as much as 24 months, are going to be really tough on business. And as much as we want the tax deductibility of everything that we can. Putting things further at risk for the sake of a little tax, for the sake of the tax deduction, needs to be something that you need to be really mindful of. And the pressure of this is actually, I know, not necessarily coming from accountants saying, hey, let's refinance it for the tax deduction. It's the fact that the social media now is pushing a lot of these directors to go, hey, why haven't you thought about this? So if you have clients that are coming in for their annual review, they have tax debt in place. And even if they are in a consistent payment plan, if they start having discussions about wanting to refinance it for tax deductibility, it may be worth having a look at what a plan B would look like to actually get rid of that tax debt instead. Yeah, obviously that's a fairly drastic measure when you think about doing a restructure or doing a VA or looking at an SPR, but it may not be as drastic as the risk of actually going and putting it on your own house, a debt that may then and I've spoken about this example before. We had a client last year came to us, had a $350,000 tax debt. There was 120 of it was from an expired DPN. We looked at, we suggested that they do a restructure that would get rid of most of the debt, and then we would only have to deal with the 120,000 that was already an expired director penalty notice. They chose to go down the refinance path then, and not for tax deduction purposes, but they felt like it was the more right thing to do. And this is the other thing that we're finding is that, and it's really great that Australians love to pay their tax and put everything at risk for it. But they chose to refinance the tax debt of the 350,000 and went about their business. Over the next 12 months, leading up to a couple of months ago, they continued to have, they tried to run the business, they continued being tight, and as it turned out, they started accumulating more tax debt because they really didn't fix the core of the problem when they refinanced. And I'll come back to that point because it is something that we're seeing a lot of at the moment. So they came back to us and said, oh, look, it's really, it's not working out. We're starting to build up debt again. So the only thing that we could do was to actually help them do a controlled exit to get out of the business now, which we're in the process of finalising. But that 350,000 is on their house. Now they're going to go and get jobs and they can make good money, but they've now got an extra 350,000 that they're going to have to pay off over the next 10, 15, 20 years. And we all know the maths of the amount of interest that you pay on that debt because you've rolled it into your home over a period of time. So I can't stress enough for everyone to please really think carefully and work carefully with your clients who are thinking about moving ATO debt into a secured format in any type of loan. And I've been saying that for a long time to do that for any reason, but now more than ever, you've got massive amounts of media out there, a lot of advertising that are trying to convince people that they should be that they should be refinancing their tax debt so that they can get the tax deductibility. So it'll just be another push that will potentially make a client go and do something that isn't necessarily the smartest thing for them in the long term. So please keep that in mind, keep an eye out on it. And I understand, going back to something I mentioned before, I understand that we've got a lot of clients who, and the Australian psyche is very much, I need to do the right thing, I need to pay my tax debt, I need end payment plans. But in both cases, I think it's really important in a market where we've now got lower profit margins, lower margins, lower profit, to make sure that a client understands if they're going to enter into a payment plan, if they're going to refinance it and then try and pay that off over a period of time, do they actually have the profit to cover that legacy debt? Because what, again, we're seeing this more and more at the moment is that we've got clients coming back to us who said no to us 12 months ago, and that's okay because they were hopeful. They're now coming back with either bigger debts or some of it refinanced, or the one thing I really hate is a lot of this fintech debt, which for years I've been talking to you about how much I dislike it. And they've kept trying to put themselves over the line until the next magical thing comes along. Now those magical things aren't coming, and they're putting themselves under pressure, but they're still trying to find ways of staying alive. And that's I love the fact that we are a country that really wants to try and fight through things. But sometimes the best way to fight is to restart, is to have that the reset of the business through a restructure, through an SBR, through a VA and DOCA, using the insolvency laws as they're designed to be there as a protection mechanism, to help a business get a fresh start. Now, the business wants to be viable, but a business can be viable as a fresh start rather than having to deal with all the legacy debt at the same time. So when you're having these conversations, particularly with clients who have some outstanding tax debt and maybe some other issues, just be mindful of all of those numbers and trying to help the client to understand just how much extra they need to make to cover what they're talking about trying to do, rather than just surviving out of cash flow. There is a really clear options available to clients. Us as a firm are more than happy anywhere in Australia to come and meet with your client and put together a plan B, put together a quote for them of what it would take to do the restructure. And at least they would have that concept, have that available to them. There's no obligation, you all know that. But it would be, in my mind, there are a lot of clients that need to know that there are options out there because the fight sometimes is too much. So back to my original point, please be aware as you've got a number of your clients will be being, I want to say harassed, but it's not quite harassed because it's online marketing, but there's plenty of marketing out there for clients saying, get your tax debt, refinance now so you can get the tax deduction. Please keep a really close eye on that, and be mindful of all of those pitfalls of people who might go down that path. You can't talk about annual reviews without talking about structures. And there's we all know that a good structure has got trusts and it's got companies and all the rest of it, and not sole traders and not partnerships. And we've talked about that at length over the years, and I will go through some more of that for the time in a minute. What I wanted to highlight at the moment, or in the first instance, is I want to talk about when we onboard new clients to or new businesses that people have come up with, and even with all the distress that's out there, there are a lot of new businesses coming into the fore at the moment. So we've got a lot of people who were in the workforce, have got sick of the workforce and decided that they want to work for themselves. There's people who've come up with new great ideas. Apparently AI can help you come up with a new idea and turn it into a business plan in 3 minutes. And then people are actually deciding to go ahead and do something along those lines. And again, from my past of 15, 20 years ago, I know when a client comes to us, they want the cheapest way of getting started. So we see a lot of businesses start as a sole trader business. And then when you do your annual review, you go, right, now you're making enough money, let's move you into a trust or move you into a company structure, and you go about that process. Really smart thing to do. Sometimes we can't get them in there at the start because they don't want to spend the money to set up the real structure. So you then look to move them through. One thing I want to really highlight is that when you're moving them from a sole trader business into a trust or a company or a trust and company structure, there are more than just the accounting implications of having it brought into the new structure. There needs to be a sale of business done because we actually legally need to get the business out, because if that business in the company structure gets into trouble, there is an argument that it was moved in there falsely without it being a sale. So if you are going to move a business into a company structure, please make sure that there is a sale agreement in place where the business and its assets are brought across. Now, it may just be the business that's brought across. You might want to keep whatever assets there are personally. But if you are going to do that, then you need to have PPSR leases in place that the business is using someone else's personal assets. So there are some structural and legal things that need to happen as part of that transition. Don't just look at it as an accounting transaction to bring it across. The other big consideration with it is making sure that the client reestablishes all of their trade supply accounts. I've had an example of a client late last year, got themselves into trouble in the company, came to us to deal with the company. When we had a look at it, they'd been transitioned into a company structure the year before. When we had a look at all the trade accounts, they were still all in the director's personal name because they'd moved the business across from accounting and redone the invoicing and got a new ABN and started invoicing the clients under the company structure. But all of his trade accounts were still stuck in his original name because it was never transitioned fully over. Now, in some cases, when we're transitioning supply accounts over, they will still have a personal guarantee, which will come back and bite if we get into trouble. But there are a lot still that don't have personal guarantees on their trade suppliers. So by closing out the personal account and opening up a new account in the new trading company's name, one, you may get away from the personal guarantee and have the access to the corporate veil that we want. But at worst, what we find is that even when you do need to liquidate a company that has personal guarantees, not everyone wants to chase the personal guarantee. So you're actually creating a separation that may give your client some extra protection that they didn't have before. But if it's in their personal name, then in this particular case, we put the company into liquidation. Everyone's gone, oh, well, I've got a personal account. So then we had to start dealing with some attacks at the bankruptcy level for our client. Now, that may not have been the case if he had actually gone through the process of transitioning the creditor accounts. So I think it's great when we're doing our annual review that we're looking and go, okay, we need to move a corporate structure. But if you are going to move to a corporate structure, either ensure that those extra steps are taken, or you're welcome to give us a call. We will work with one of our strategists, and we will assist in the sale of business and the transition of creditor accounts for clients to ensure that that structure is moved across fully. The other thing I'll say as a side note to that is when we talk about personal guarantees, I would highly recommend that you put into your checklist that people talk about developing a personal guarantee register. If they put together a list of all of their trade suppliers, if they find the original paperwork and work out whether they've got personal guarantees on the account or they don't, does the trade supplier have a caveatable interest? So someone like Bunnings, for instance, you have a trade account. The company might set it up. It has a personal guarantee, but within the Bunnings credit supply account, they actually have a caveatable interest clause that allows them to then put a caveat on a house. Now, they don't do that unless they get into trouble. But when a client comes to us and we talk about, okay, we're either going to need to restructure or we might need to shut down because they've decided it's not worth being in business, we then need to work through all of that process. Having a pre-armed, having a personal guarantee register with that information in gives the director some comfort of knowing where they may or may not be attacked. So again, maybe something that you can add to your checklist for them of things that they should think of doing is developing, particularly if they're a client that's in some level of distress and they're a bit worried about what the next 12 months might look like. There is value in actually starting to put that together when you're not under so much stress. The other thing that I'll talk about, and this probably ties a little bit of the lending money and structure together. I had a call from an accountant last week. I had a client who's in a partnership. They had recommended a company trust structure, but apparently years ago, the finance broker had said it needs to be in a partnership because that's the easiest way I can get the original lending. So they've run this business quite successfully for a number of years in the partnership. Last 24 months have been a little bit tricky. ATO has built up. They've moved to new premises, which then had some extra cash flow costs that they weren't anticipating, and they've had to pay for those capital costs out of their cash flow, which has then led to them using fintech lenders to try and get some more money to survive. The accountant's now working on putting together a decent finance package, getting a proper finance package where it's not at the 17s and 20%. And they're going to borrow about $300,000 to help pay out some of these other financiers and to give them a little bit of working capital to move forward. Most of it is actually not going to go towards the ATO because their bigger issue are these really high interest loans. When we were talking about the scenario and the risk of the ATO, I said to them, well, if you've got this 300,000 coming into the business, and this is, I guess, what I'm trying to highlight for everyone today is, again, looking at some of these structures that you're doing, why don't we use that $300,000 as the purchase or potentially the purchase of the business into a company structure? So they're borrowing the money personally. They would have the ability to lend that to a new company that they could set up for the two partners of the business. That company would then purchase the business off the partnership and allow us to move the company move the business into a company structure so that we would then have some protection moving forward. Now, it doesn't deal with the tax debt in the partnership. So we still need to look at the longer term strategy of how we pay down the ATO. And there are a number of things that I won't go into today that will allow us to do that. But if we're raising this money now, and if we can use that money to actually move it into a corporate structure and use it as part of the sale price, that just gives us a longer term added protection for the business. So rather than just getting the money, dumping it against the debt, let's see if we can use that money in two ways to help protect the clients longer term. They still have really good prospects in what they believe the business will become and what it will become again. But in doing so, we can actually start structuring it up a little bit better for the long term. So when you're talking with clients, whether it be in the next month or any time through the year, when you're looking at any capital raising, if the company is in a sole trader, in a partnership, in a trust with a individual trustee, any of those things, now's the time to consider doing the transition. Now, trust with an individual trustee, that's a different transition. But what using the example that we've got, that 300,000 that we're actually going to borrow, we are now going to very quickly get a plant and equipment valuation, get a goodwill valuation, put a sale agreement in place, still get that money through quickly to pay out these high interest lenders, but now we're going to put it through a second structure, which is actually going to mean that we can move the business into a safer place, because one of the partners is quite old and is looking to retire. So it will allow us to extract that partner over time as well, because otherwise, once they do retire, or as it is in this case, there's the potential that they may pass, we then have a partnership without a partner. And that, as you all know, that creates a whole new kettle of fish and a whole new bunch of problems. So just something to consider, again, when you're looking at doing some refinancing the business, some recapitalising the business, make sure that if the structure's not right now that might be, that use of money might be an opportunity to transfer that sort of stuff through. We can assist in all of that restructuring and setting up the documents towards the sale agreement. So if in the future there is a problem, we know that there is going to be no issue with a liquidator looking at that transaction from the past. So just again, something to consider when talking with clients at the moment. I can't talk structures and I can't talk risk without talking about directorships. I know it's boring. I know it's old hat, but we still see way too many companies that have got husband and wives, both as directors of a family business. There is no reason in my mind that we ever need to put both partners at risk of a business. Family law can break through any structure, including superannuation funds, so that you can't, no one can go, we need to do it because we need to be fair and equitable. Family law can work through anything, whether it be in a positive or a negative way, but family law can work through all of it. The need to put two people at risk should just not be there in a family situation. So pick someone to be at risk, and take the other one out of it. They can stay as shareholders. I don't have a problem with what you do at the shareholder level, but at the director level, there is really no point putting both people at risk. Really simple one. I will make it clear, though, that if you remove the director today and there is a tax debt, they are still potentially personally liable and can still have director penalty notices issued against them for any tax debt up to the date of their resignation. So if they've got unpaid super, they've got, even if their DPN hasn't been issued as at today, the ATO can issue a DPN for 3 months, in 3 months, that picks up debt from before they were removed as a director. So it doesn't get rid of old debt, but it does reduce the risk of future debt, and something that we need to be mindful of. The other thing that we're seeing a lot of, and again, as people get in distress, we start to see a lot more of the stuff that's just been happening in the background. Couple of things where it comes to the family home. One of them is that we have seen over the years a lot of people get advice to move the house into the wife's name. So they've listened to the advice around directorships, and without being sexist, we'll say that the husband's taking the risk and the wife's going to hold the asset, and they've moved the house into the wife's name for natural love and affection. If there is an insolvency event in the future, particularly at that personal level, moving a house for natural love and affection does not work. That can be undone by a bankruptcy trustee and the house will still be at risk. There needs to be a purchase of the equity by the spouse that's actually taking control of the property. There needs to be a sale of the equity or a sale of their share, for it to be safely in the other person's name. That's quite complex to do, but again, putting equity deeds in place and doing things like that can be done. If you have a client who either you have advised in the past, or has come from other advice to do that, and again, they are a business that you're even worried about, or even if you're not worried about them, getting that fixed now is really important. So reach out to us, talk to about the situation. We can give you some guidance there. We can also, provide some structure for you to move forward to help that client rectify that situation so that if in the future there is a problem, it can be dealt with. It can be dealt with properly. The other one that's becoming a real issue is that we're seeing a lot of clients who have got the house in the wife's name. It's always been in the wife's name. All of that has been done properly. But what's happening is the husband's paying the mortgage, or the husband is putting their salary into a joint account, and then the joint account is paying the mortgage. If you have with any of your clients structures where the wife has the house or one party has the house, it's important that they're earning enough money to look like they can sustain that mortgage. So normally, and I'll give you an example. I've got a client at the moment at a family home, 3 investment properties, all in the wife's name. Even the deposits can be trailed back to the wife's name. All that sort of stuff is in place. There's mortgages on all of the properties. One of them's through a line of credit that's covering the 3. The husband's got quite a strong business with a big cash flow, so he's got a lovely salary coming out of the business that's helping fund the mortgages, and the wife's got a little salary coming out because she's not heavily involved in the business. So when the husband's salary is coming out, that's going into the joint account, and that's paying the mortgages. Now, as it turns out, due to some fraud issues, the business is now we're needing to look at doing some restructure work. There is potentially the risk that they're down the track, our client's going to have a personal insolvency issue on the back of what the fraud has been. And I'm not going to go into the technicalities of that, but our client personally is at risk, and he's gone, oh, well, all my properties are in the wife's name, it's okay. What we've discovered is that basically for the last 5 years, he's been paying all of those mortgages. So what that means is it looks very much like he is buying an equitable interest back in the property. Now, with an aggressive trustee or with any trustee, if they believe that they're entitled to a share of those properties, and we all know what properties have done in the last 5 years. So all of a sudden we've got this extra equity in there that we need to play with and deal with, that on top of just the money that he's put in, he's had the equitable growth. So if you've got either clients who've got an old structure or you're talking about setting it up for a new client moving forward, if you're putting if the wife is going to buy the house in her name and there's going to be a loan against that name, make sure, whether it be with her own salary or a salary through the business, that her income is high enough to support the payment of that loan. Doesn't need to meet bank requirements, that it's individual in that way. But from our point of view, when we're dealing with it with distress, it's got to look like and go so far as the wife needs to have an account in her name only that the mortgage is paid from, not a joint account. So when you get married, or when I just passed my 20-year wedding anniversary, and when you get married, you go and open up a joint account, and you do all these great fun things, but you still need to have individual accounts. And if you've got individual structures and asset structures like that, please ensure that the payment of the mortgage is coming out of the wife's personal account. So that way, again, we're all talking about the hypotheticals of if something goes wrong. And some of you might have heard me talk about in the past that Stephen Covey talks about in his 7 habits of highly effective people and highly successful people. One of those habits is start with the end in mind. The problem is that most people start with the positive, thinking with a positive end in mind. when I start this business, I'm going to make millions of dollars and I need to have a trust account so I can distribute the profits and get the capital gains flowing down the right way and all that sort of stuff. But we also need to think about what happens if the end is not great. So we do half of these things really, really well. We put the house in the wife's name, but then we undo some of that great structure. So when we're looking at some of these things, when we're talking with clients through the course of the next month or so, and to be honest, it's all year round, but we've obviously got the annual review stuff coming up now. Have a look at some of these other things that I've been talking about, because it does add a layer of protection that may be needed if things get into trouble. And let's face it, the next 12 to 24 months are going to be tough for any business. I don't think, I talked at the start about construction and hospitality, but profit margins across all businesses are tight. It's hard to get paid, so businesses will struggle with their cash flow, and that has impacts. So any business is going to have to be really make sure that they've got themselves covered. And some of these little insurance policy things that we can put in place now are really worth considering and having a look at. Each situation is very different, so please reach out to any of our strategists, give me a call and just chat through a scenario. Some of it is never going to be work for us. It's really just give you some guidance so that you can put things in place. Other things will be work. And we'll be happy to be involved in that. At the end of the day, I would love to spend more of my life doing asset protection, and then the insolvency stuff becomes really super easy because all of the asset protection's in place. That's not the case and not always the case for us. We're still very much here to deal with people who have got garnishee notices, DPNs, all these other things. And please call us for all of those. But any of these other things I'm happy to look at as well. That pretty much wraps up what I wanted to talk about today. Hopefully there's something in there that you got some value out of, that a client that might pop up in the next month or two, or next 12 months. So please keep that in mind. Reach out anytime you want. The girls have put the poll up already, so please put your comments down, any thoughts, anything we can do to help. We'll open it up for questions. If anyone's got a question or a comment that they want to make on any of this sort of stuff, please either unmute yourself or put it in the chat. Otherwise, we'll come close to wrapping things up.
Ashley, you mentioned at the start that I think the ATO are not willing to write off. Is that what you mentioned at the start? They're not willing to do that now, or
write off tax debt.
Just tax debt, yeah.
So what we're finding is that they're certainly becoming a lot less interested in helping reduce interest and charges. So the penalties and interest, they're not looking to reduce them. Where we're starting is that it's now no longer going to be a tax deductible expense when you pay the interest on tax.
I'm talking about hardcore debt, not just the interest in.
So hardcore debt, it's actually really interesting. They don't actually have the ability to write off core debt. It's actually the only person who can do it is the treasurer. So what you can do with core debt, well, what the ATO can do is that they can quarantine some of it, and I've very rarely seen this, but I have seen it. They will quarantine it, saying that they will never chase that legally. But the debt actually still remains as a live debt, because there is no, I'm not a lawyer, but my understanding is that there is no capacity within the Income Tax Act for them to actually write off core debt. They can decide not to pursue it. They can write off interest and penalties, but they can't write off core debt at all. And certainly what I do know is that superannuation, they will chase, even if it's a really small amount, because they feel as though they've got the right corporate duty to do it for everyone else. So even if you have a small director penalty notice for superannuation, they will pursue that very hard. Hope that helps, Brad. Thank you for using the unmute. So much easier than reading and typing. All right. That pretty much wraps it up for everyone. I'm happy to stay online for a minute or two if someone's got another question. But for those who want to go, there'll be nothing new that comes out of it. So thank you very much for joining us again this month. We will be back in June for the end of financial year. We'll do a bit of a wrap up on things there. I'll work out what's most current stuff to talk about, and we'll do that where we can. But apart from that, thank you all for joining us, and I look forward to seeing you all again either next month or please reach out and give me a call anytime you need.